Hello traders and investors, welcome back to my channel. This is Jonoy with Trading the Charts Pro. Alright, and in this video guys, we're going to talk about how to protect your account using call options in a situation where the market is selling off. Alright, so how do we create a strategy as an investor, meaning we have some long-term position that the market is selling off and we want to protect the positions without actually liquidating the position. All right, I'm going to break that down and show you how it's possible with a little bit of a technique and skills for you to protect your account and make some money while the market is actually selling off. Okay, so guys, if you are new to the channel, I ask you please like, subscribe, turn on your notification bell so that when the next video comes out, you'll be the first to get notified. All right, let's jump in and start talking strategy. All right, so guys, first thing we want to know is basically what is a call option. All right, basically a call option is just a contract that gives you the right, or the owner of the contract, the right but not the obligation to buy or sell a specific stock or commodity or currency, whatever it is, for a specific period of time. All right, the specific price is also known as the strike price. The specific time is considered the expiration date. All right, typically some persons use call options for speculation, or they are used as a form of income. How are they used as an income? Well, you can sell premium to someone else and have that premium decay as profit in your portfolio. Okay, so typically if you have 100 share of a specific stock, which one contract control 100 shares, so if you have 100 shares of, let's say, Microsoft at $100, you can go out of the money and sell a $120 strike price, one contract call option to someone for a specific period of time, for a specific period, a specific price. And that would actually be a strategy where you're protecting that position that you have, that you bought at 100. You're saying that, hey, if price gets to 120, somebody can call you out. They can take the stock from you at 120. That is one way. The second way is if you sell a 120 option, call option, that is against your position, and the market actually sells off. So let's say the Microsoft that you bought at 100 now end up going down to 80 or $90, but you had sold a 120 call option to someone else. Depending on what expiration date you sold to that person, you typically, which is like 30 or 60 days, if that 30 or 60 days has passed and the stock is not at or above the $120 strike price that you sold to that specific person, now you get to keep whatever the premium was that you sold the option to that person for. So as it relates to selling options for income, that would be one way to do it. All right, let's jump over and cover just a little bit more information in how we use these options. All right, okay, so call options as a strategy. So basically guys, if we're going to sell an option, right, typically let's say we buy Microsoft again, and we buy Microsoft at $150 right now. Okay, we buy Microsoft at $150. If you want to protect your 100 shares right here at $150, what you can do as it relates to selling an at the money option is you would go out 30 days, whichever month it is, you want to select a 30 days option, and then you will sell an out of the money option. So what is an out of the money option? an out of the money option is going to be any option that is greater than the current price, which the current price is 150. So you can go out 10 bucks out of the money, which would be 160, or you can go out 20 bucks out of the money, and that strike price would be $170. Okay, so you have 100 shares of Microsoft, and you basically go and sell. You would sell to open one contract of the $170 strike price. So in the event that the market starts to sell off, this $170 strike price that you sold, you may have sold it for, let's say you sold it for $15, right? You sold it for $15 right there. So basically, because 100 contracts, one contract control 100 shares, the $15 for the entire contract would be $1,500. So you'd actually brought in a premium of $1,500 for the 30 days that you sell the option for. Okay, so now if the market start to sell off, guys, what actually happened is you have created a cover call, meaning now you sell the out of the money option, which is going to cover the $150 that you bought the Microsoft for. Does that make sense? I hope it's really, making sense for you. So if the market drops, now this 170 strike price that you sold for $15, depending on how far down the market goes, this may end up be going for around $7, depending on how far the market drops. So minus 7 from 15, you're left with $8. So if you come back in and buy back this option for $7, you would have ultimately made $800 in profit. Okay, and now because you're still holding your long-term position, you can wait and allow that stock to recover, given that at the time when you choose to buy back your option, the market may have found support. All right, so that is an example of selling an out of the money option. Okay, all right, the next example is going to be selling an at the money option. What is an at the money? So basically, at the money option is going to be, you bought the stock at $150 and you're anticipating the market to sell off very, very, very hard. All right, so you can actually sell to open one contract of Microsoft. So you do one contract. Again, we use the same example. It's going for around 15 bucks. So this would be $1,500 because one contract control 100 shares. So when you multiply 15 by 100, it's gonna be 1,500. So you brought in $1,500 for the premium, right? The at the money really means you're selling the exact price that the stock is currently trading at. Okay, so that's what at the money really means. And then if the market actually drops, you have literally protected your position, because let's say price dropped down to $140. Well, something that you bought at $150 is now going for $140. So very likely, just like the previous example, the option that you sold for $15, which is, same example, it may be going for around 10 bucks right now. Okay, and given that you've read the chart and see that, hey, price is at support, now you can buy back that option that you sold, or you could just wait for expiration. That is one way. You could wait for expiration and just collect the entire premium. But typically, I like to close these out whenever I'm in the profit. So if it's going for 10, now I bought it back for 10 and I've made $5 profit in premium, which should ultimately be $500 in a week, or 7 days, depending on how fast the market is moving. Okay, so I hope that kind of breaks it down a little bit, show you how you can sell a at the money call option or a out of the money call option to protect whatever stock you're currently holding in your portfolio without actually liquidating the position. Let me emphasize that in order for you to sell a option against a position that you currently own, you have to have 100 shares of the stock, because it will not be a cover call unless you have 100 shares, and then you can sell the one contract against it that controls 100 shares of stock. Okay, so if you have 1,000 shares of a specific stock, you can apply this very same principle, but now you'd be selling 10 contracts for $15, so it'd be 10 times 15, and that would ultimately bring your premium that you're bringing in to around $15,000. And depending how far the stock drop, then we'll just multiply all of that profit by 10. Okay, so guys, if you own the stock and you go ahead and sell a out of the money option or a at the money option against the stock that you currently own, that strategy is considered a covered call. Now, if you are an option player like myself, which typically I like to buy only options, it depends on what's going on. So let's say I buy 10 contract of something, I can always come on out here and sell a out of the money strike price, and now this strategy ultimately becomes a spread because I'm selling a option against a option. Okay, so guys, I hope this really brings a little bit of new ideas to you. And like I say, in the stock market, it's like building a house. You cannot use a saw or a hammer to fix every single problem. So you do need to have different strategies in your toolkit so that you can navigate these markets. Okay, I want to go ahead and break down a live example of how I apply these very same strategies to make money in the market. Okay, so I'm gonna bring in another diagram here. Okay, all right, so right here, guys, you can see this is BA. So Boeing, I actually had the January 15 options right here, the 55 strike price. So I was able to make $2,443 selling a out of the money option on BA. I was holding some call option, but price was going down, so I decided to sell a option out of the money, which is higher than the option that I currently own. And as price fall down, I was able to make money. So though my current option is losing money, the option above it was losing money a lot faster. So let me bring in the charts and give you a clear breakdown of what I'm actually talking about. Okay, so you can understand and see how it's very possible for you to apply these very same strategies. All right, so let's look at it. All right, so right around somewhere here, I was very bullish on Boeing. I feel like the consolidation was probably going to be over. Hence, I went out and I bought some $150 call options. Okay, but as soon as I bought those $150 call options, that expired in January. So January, $150 call. I think I paid like $41 for one of those. Okay, as soon as I did that, guys, what happened? Price starts to fall down, but because I'm able to read the charts, I don't get scared. I don't decide that, hey, I'm gonna liquidate my position because price is going against me. If I have a January option, that's a lot of time, given that we're in September, so we have like 3 months or 4 months. And when I look at the chart, we have a support right around 156. So yes, I was probably wrong for buying too early. So what do? Do I liquidate? Do I cut a loss? No. What I did was I came inside here. I went to January and sold some January 155 option. So this option now is a out of the money option. Why? Because I currently own the 150. So though price is at $170, you know, because I wanted to protect as much of the $41 that's currently in my position, I actually just go ahead and do a option that is just $5 out of the money from the option that I currently own. Okay, so I was able to sell that for maybe $26, and I had like 5 contracts, so I think I brought in around $15,000 premium. Now the more the stock fell from 170 coming all the way down to 156, this option that I sold was losing value. So I sold it for 26, and as price dropped, it came down to around $20 or something like that. So I make around $5. Okay. Now, yes, the option that I own is losing value too. But what is very important is that I saw that this is support. So as soon as price fell to $156, which is the support on the chart, I went ahead and I bought back this option, which is the out of the money option that I sold. And now I bought it back for around, I think I bought it back for around $21 or $20. So you minus $20 from 26, I would have made around $6 profit. All right. So 6 times 5, you know, that's around 30. By the time I was able to get out of the position, my profit was $2,443. Okay. Now you're like, well, how do you make money? Because your position down here is losing a little bit of money. Well, I just made $2,443. I closed this position here out, and guys, look what happened. Price came right down to the very support, and price has bounced. Okay, so my option now that was losing money actually start to gain back all of that profit that it was losing. So by the time January comes around, this thing may be somewhere up here in the 200 range. Whatever it gets to, that means that whatever profit I do make later on, I'm going to add $2,443 to my profit. So my net profit is going to be bigger. So what I really wanted to get across to you is that you don't always have to close out the position. And in this example, I had January options, so there was no need to just close out the position and take a loss. Instead, I sold a out of the money option. I made $2,400 in the short term, and I still have until January to wait for my position to recover. So guys, I hope you definitely found some value in this video. If you did, again, please like, hit the subscribe button, turn on your notification bell. And if you have any questions, just put them down there in the comment section, and I'll definitely be down there discussing it with you to see how I can help you to understand these strategies and potentially put them to work for you. All right. If you like to find me, you can find me at Facebook, Trading the Charts Pro Community. And this is our free community where we put out a lot of value, chart patterns, stuff that we're looking at just so we can grow together. All right. So I look forward to seeing you in my next video or over there in Trading the Charts Pro Community. I look forward to see you then.